Before inviting the keynote speaker of the day, Professor David Parker, let me give a brief introduction to him. Dr. Parker is widely recognized as a real estate academic and an industry practitioner specializing in property valuation, property funds management, expert witness, and mediation, being a director and advisor to real estate investment groups, including listed real estate investment trust, unlisted funds, and private real estate businesses. With over 40 years professional experience, Professor Parker is a professor of property at the University of South Australia. He's also a visiting professor at the Henley Business School, University of Reading, United Kingdom, and a visiting fellow at the University of Ulster. And Professor has written 4 books with further 2 books currently in press, authored 10 book chapters, published 39 papers in referred academic journals, and given 9 keynote conference presentations. Further, as an industry practitioner, Professor Parker has managed multiple property investment funds, was the Valuer General of New South Wales and the General Manager of the Commonwealth Australian Valuation Office, was an Acting Commissioner of the Land and Environment Court of New South Wales and a sessional member of the South Australian Civil and Administrative Tribunal. Today, we have the privilege of benefiting from Professor Parker's insights as he addresses us on a topic of great significance and relevance to our conference theme. Professor Parker will undoubtedly inspire us with his vision and wisdom. Ladies and gentlemen, please join in me with extending a warm welcome to our esteemed keynote speaker. Professor, the session is over to you.
Good morning. Can you all hear me?
Good morning, Professor. Are we audible to you?
Yes, I can hear you. Can you hear me?
Yeah, we can hear you loud and clear. So
Splendid.
So the session is over to you, Professor.
Okay, perhaps we could put the first slide up, please. That's terrific. Thank you. Well, thank you very much to the organising committee and the university for inviting me to speak today. I was interested to hear the previous speaker talk about the challenges of asset valuations. And remember, when I was running the Commonwealth Government of Australia's valuation business, we had to value the Australian Broadcasting Corporation, the ABC. And they had a wide range of property assets, all the studios, the office buildings, a wide range of plant and equipment. You'd expect there were the cameras, the sound equipment, there were the series of boats, and there were a couple of helicopters. And they also had the bananas in pajamas. And it turned out that one of their most valuable assets was the bananas in pajamas. Now, I'd like to talk today about the capitalization rate conundrum and some of the principles, practices, and how to conquer industry problems. So if we go to the next slide, please. 1976 was a big year. Now, I did have the benefit of some screenshots of the audience whilst I was listening to the previous speaker, and I can see there are some people there who, like me, would remember 1976. If we go to the next slide, please. It was a particularly big year in the US for the bicentennial, their 200 years since formation. 1976 was the year that Apple Computer Company was formed and Jimmy Carter became the US president. Legionnaire's disease first broke out in 76, and Rocky, or as we now know it, Rocky I, was released. And Fidel Castro was elected as the president of Cuba. If we go to the next slide, please. It was a big year in the US. It was also a big year in the UK. It was the hottest summer in 350 years, which I remember well. It was the year when the first covered shopping centre opened at Brent Cross and was the first commercial Concorde flight. Now, from the point of view of the capitalisation of income method, 1976 was a really big year because that was the year that the Greenwell report was published, and the Greenwell report famously said that the capitalisation of income method was incorrect, inaccurate, and by deduction led to ineffective valuations. Now, that was a fairly major charge against the capitalisation of income method, and it's interesting that it was 50 years since that happened, and the valuation method is still being used. So for the last 50 years, major issues have been known to exist with the capitalisation of income method, but it still continues to be a widely used method. Now, the results of the Greenwell report was that the RICS did a major review of valuation methodologies, and they published a guidance booklet that became the first version of the Red Book. So what we can deduce from this is that for at least 50 years, we've known that unless the situation, the founding assumptions, and the circumstances are suitable for the capitalisation of income method to work, there are going to be problems if they're not. We go to the next slide, please. Now, what I'll run through is the incredibly simple nature of the method, what's generally referred to as it being deceptively simple. Have a chat about the two key variables, the single period representative income and the capitalisation rate. Then the critical one, how to adjust the capitalisation rate. And then have a think about or a discussion as to whether or not the capitalisation income method is fit for purpose. Have a look at the data conundrum and see what might be done about it. So we might have a look first at the next slide, please, which is shows the deceptive simplicity of the method. All you need to do is divide a single period representative income by a capitalisation rate and you get a capital value. So $1 million of net income each year, cap rate of 5%, gives you a value of the building of $20 million. Incredibly simple approach. But of course, absolutely everything has to be represented in one of those two variables. So the single period representative income has to capture all the issues of market income levels and potential income growth, and the capitalisation rate has to capture every single other thing that may impact on the value of the property. So there's an awful lot going on in those two numbers, and as you'd all be familiar, if you get one of them slightly wrong, then the capital value will change. Let's have a look at the next slide, please. Now, capitalisation of income method works best when everything is calm and under control. If we have a stable property market, we have stable properties, and we have stable comparable sales transactions, and the subject and the comparable sales have relatively simple risk profiles, the capitalisation of income method will work really, really well. There's not much that can go wrong, excuse me, when we have simple properties in stable markets with lots of comparable sales transactions. What we're basically saying there is that we have a data set and information that is complete and reliable. Everything that we need to look at, we can find, and when we find it, it's correct, it's accurate, and we can rely on it. Let's have another next slide, please. So let's look at the two key variables in a bit more detail. First of all, the single period representative income. Next slide, please. Now, I keep saying single period representative income, where most people would say net income, because it doesn't necessarily have to be net, it just happens to be in most of the ways in which the method is applied. But it's effectively some representation in a single period of the income stream of the building. Now, as you'd be aware, there is some underlying theory in the income stream. One is that it's the prevailing current market income. So you might have a term in reversion valuation where the reversion is market, the term is a lower or higher amount, and you adjust through a term and reversion approach. But generally speaking, there's an assumption in there at some point of the current prevailing market income. Now, within that income, there is a growth assumption, and effectively, you're assuming that that income is going to grow either constantly or consistent with the market. So it's not that it's going to stay flat, it's accepted that it's going to grow, but the growth assumption for income is entirely represented in the single period. Now, I heard a voice. I don't know if you can hear me.
No, Professor, you can continue.
Okay. Now, as well as having a single period representative income, it's conveniently assumed for a freehold property that that income is going to continue into perpetuity. So the method essentially has a massive built-in assumption about income, that the current market level is what you're going to get forever and ever, and it's going to go up at whatever rate the market goes up at, or it's going to remain constant. So that's a pretty big assumption. And it's also implicit that you have enough comparable sales transaction properties from which to deduce what the current market income is. Next slide, please. Now, a slightly more detailed level of assumption is that the income stream that you're valuing and the comparable transactions that you're using will have similar rent review profiles. So, for example, if the subject property has a 5-yearly rent review profile and the comparables have 3-yearly rent review profiles, the rents are probably going to be different at a market level. So there's an assumption that whatever comparables are being used have a similar rent review profile, frequency and basis to the subject property. That goes a step further when basically there is also an assumption that all the other lease terms are going to be largely the same. So anything that might impact on income, such as outgoings levels, costs of repair, the ability to assign the lease or not assign the lease, is assumed to be the same. Because if it was different in the comparable properties, some kind of adjustment would be needed to be made to that market income for application to the subject property. Now, where there are differences, it's assumed that they can be reflected in some kind of manual calculation. So maybe term and reversion approach.
Recording in progress.
Just try and remove that. Excuse me. Term and reversion approach, different rent review patterns, or repair costs. So you're either reflecting these differences in the single period represented income, or that reflection is going to have to go into the capitalization rate. Now, the critical thing with adjustments such as this is that they become dependent on value adjustment. And where we have value adjustment entering the valuation process, we have the risk of uncertainty and possible inaccuracy. Next slide, please. So, for the capitalization of income method to work best, the ideal property is a single tenanted property let at market rent. Now, they don't come along very often. You do get some of them, but in the majority of cases, you're probably going to have to be looking at something that's not a single tenanted property let at market rent. And so the capitalization rate, the capitalization of income method is going to start from a position of disadvantage. So if it's not let at market rent, some kind of adjustments can be required, term and reversion approach. If there's more than one tenant and different lease structures, adjustment will be required. And as I mentioned, any adjustment requires value adjustment. Next slide, please. Now we'll have a chat about the capitalization rate. Have a look at the next slide. Now, the capitalization rate, as you remember, is one of the two key variables. Everything that you are seeking to reflect about the subject property being valued compared to the comparable sales has got to either be in the single period representative income that we've just talked about, or the capitalization rate. Now, the capitalization rate is the large catch-all for every aspect of the property that's being valued. Fundamentally, it has regard to the time cost of money, and it also has regard to any, I can't read my slide because there's something underneath. Let me just see if I can move this. In regard to all the rewards attaching to the income stream other than rental growth. So it's implicit that the capitalization rate will have regard to the risks attaching to the income stream. So essentially, anything that's hitting rental growth should be reflected in the single period representative income. Anything that affects the risk of the property should be in the capitalization rate. And it's implicit that there are sufficient comparable transaction properties. Now, we'll talk in a moment or two about how comparable does a comparable need to be. But the key point at this stage is there need to be enough of them to provide a sufficient amount of information and a reliable database to draw conclusions on prevailing market cap rates. If we have a look at the next slide, please. Oops, I think we need to go back one, thank you. Okay, so as with the single period representative income, the capitalization rate has got a whole stack of theoretical foundations. Now, the critical one is that it's implicit that the subject property and the comparable transaction properties will be in the same sector, subsector, and geography. Now, at a macro level, this is easy to explain by saying you couldn't use the sales of shopping centres to value office buildings. If we come down a level, you can't use the sales of suburban office buildings to value CBD office buildings. And obviously, the sales need to be in a very close geography. So in our context, office buildings in the Sydney CBD need other office buildings in the Sydney CBD as comparable sales, not office buildings in Sydney or Parramatta. It's implicit that the subject property and the comparable transaction will have similar investment characteristics. So an investor would be relatively happy to take each property because they're broadly similar. If they aren't similar, then there's going to need some kind of adjustment. And the assumption within the capitalization of income method is that any differences between the subject property and the comparable sales can be reflected by adjustment of the capitalization rate based on value judgment. Now, as I mentioned before, when we adjust based on value judgment, we introduce uncertainty, and with uncertainty, we have the risk of inaccuracy. Could we have a look at the next slide, please? So as with the single period representative income, the ideal comparable sales are of exactly the same type of property and lease structure. So a multi-let CBD office building in the City of Sydney, ideal comparable sales are other multi-let CBD office buildings in the centre of Sydney. If they're not the same type of property, some kind of adjustment is going to be required. If they have wildly different lease structures, some kind of adjustment will be required. If there's issues with the quality of the building or requirement for works, some kind of capex adjustment will be required. And as I said, any adjustment requires value judgment. If we go to the next slide, please. Now, in the old days, show my age here, adjustments to the capitalization rate used to be in increments of 0.25%. Then in Sydney, we started seeing major buildings transacting on 4.5, 4.75% cap rates. Now, when the building transacts at a 7.25% cap rate, a 0.25% difference doesn't make an enormous difference to the capital value, as the first example there shows. So going 7%, adjusting by the traditional increment of 0.25% takes you to 7.25. The difference in capital values is about $500,000 Australian dollars. Once you get down to the much lower cap rates, so for the CBD office properties at the moment around 4.5, 4.75, a 0.25% adjustment makes a very large difference in capital value terms. In the case of that one, around 25 million Australian dollars. Now, what that has led to is valuers no longer adjusting by 0.25%, but by 0.1, 0.15, 0.2. These are very, very fine adjustment levels to make, for which the evidence to support is extremely low. So what we're seeing here is a high level of value of judgment being applied, for which there might be relatively little underlying supporting evidence, which places a question mark on the validity of the capital value amount that's determined. If we might, next slide, please. So, the critical issue, as professors all around the Commonwealth teach their students when discussing the capitalisation of income method, is how do you adjust the capitalisation rate? How do you bring together all of those factors that require adjustment to make the comparable sales applicable to the subject property? How do you bring them all together and reflect them in a 0.25, 0.1, 0.15 adjustment to the cap rate? Now that is a fairly major feat of thinking. So we'll certainly talk about how it should be done in theory. The practice is often a lot more challenging to explain. So have a look at the next slide, please. So in theory, everything should be happening in the risk premium. Now, what that means is that we've got a couple of variables that are less easy to play with. The risk-free rate is often a set government 10-year bond rate, 20-year bond rate, or something similar. The rental growth rate we talked about with the single period representative income. So that's often a fairly solid number. The bit you're left with is the risk premium. So in order to determine the cap rate, what you're effectively doing when you're making adjustments from comparable sales is you're adjusting the risk premium, which is one fairly small element within the cap rate. So when you're adjusting from comparable sales, there are two things that you shouldn't be changing, the risk-free rate and the rental growth rate. The one you should be changing is the risk premium. Now, one might think it's hard enough to do that when cap rates are around 4.5%, but it's not the whole 4.5% that you've got to adjust. It's a tiny part of that. So the focus of adjustments between the comparable sales and the subject property should, in theory, be solely on the risk premium. If we have a look at the next slide, please. Now, when I did my research 25, 30 years ago, I found there were 12 issues for which valuers in Sydney adjusted capitalisation rates on office buildings. Now, back then, and thinking's moved quite a bit since then, these were fairly broad categories. So valuers told me that one thing they had regard to was alternative investments, the return that you could get on stock, on shares, on bonds. Something they had regard to in determining the adjustment in cap rate was the quality of the building. So if the subject property was a newer building, a higher quality construction building, these days it might be a more green building than the comparable sales, that would be adjusted and reflected in the cap rate. The economic situation, they said, was adjusted or reflected in the adjustments to the cap rate, which is a fairly enormous collection of things to reflect in a very, very small adjustment. There was another amorphous category called growth. So we've taken out rental growth, that's a separate element. This is growth that might impact on the growth in the capital value of the building. So it's capital markets growth rather than rental growth. Any issues in the legal environment might be reflected in the cap rate. The location, which as we all know, location is often a very, very sensitive variable. Certainly in Sydney terms, one end of Martin Place is a much better location than the other end of Martin Place. So just because you have a Martin Place address doesn't necessarily mean you have a strong location. Some are better and worse than others. If we have a look at the next slide, please. Any issues with planning were caught up in adjustments of cap rate. Now, this is where my research really starts to show its age, because 20 years ago, 25 years ago, risk was just an amorphous lump. So any differences in the risk between the subject property and the comparable sales should, I was told, be reflected in the cap rate. Now we'll move on to have a discussion about how risk has later been divided up in more recent thinking, but risk is certainly one of the big things to be reflected, as is sentiment. So how is the market feeling? Is it a positive market? Is it a negative market? And separable asset class characteristics. So these are the things around liquidity, homogeneity, indivisibility of the property asset class, the general state of the property market, supply, demand, vacancy rates, incentives, and the last one, which is often one of the most significant, is the tenant. So the big debates that are often had, is it better to have a large accounting firm such as KPMG or PwC as your tenant, or is it better to have government? Who's the more reliable payer? Who's the stronger covenant? Who's got the better risk profile? Can we have a look at the next slide, please? Over the last 20 years, risk has received a great deal more attention in academic research and academic publications. And what we started to see is a division of risk as a whole into the three capital market classes, capital asset pricing model classes of systematic risk, unsystematic risk, and idiosyncratic or specific risk. Now, systematic risk, of course, is the thing that capital markets don't necessarily reward. It's the risks affecting all office property. In the case of the Sydney office property example, systematic risks are risks affecting all office properties in the Sydney CBD. Unsystematic risks are those risks affecting a part of the system, so say all grade A offices, and idiosyncratic risks are risks between individual properties. Now, this is important from the point of view of the capitalization of income method and the adjustment of the capitalization rate, because it suggests that the things that we should be focusing on in the adjustment process, when we're making that tiny little adjustment to the cap rate between our comparable sales and the subject property, are the things that are specific to the individual buildings we're looking at. And the things that are specific to the individual buildings we're looking at are probably going to be the building itself, its exact location, and the nature of its tenants. We have a look at the next slide, please. So, when you think it through, those issues in the systematic risk column should be common to all the properties, the comparable sales property and the subject property, and therefore they should be reflected in the capitalization rate of each. That's the same with the unsystematic risk column. As long as our comparable sales and our subject are all in the same subsector, they'll have common unsystematic risks, and so they'll be reflected in the capitalization rate of both the subject property and the comparable sales. Where the difference between the subject property and the comparable sales arises is in the idiosyncratic risk column, and they're the ones that need reflecting in the adjustments made to the cap rate. So whilst it's only a very, very small thing that's being adjusted, it's only really reflecting three variables: the building, the tenant, and the location, provided the comparable sales are in the same subsector as the subject property. We have a look at the next slide, please. So, when there are so many tricky things with the capitalization of income method, is it really fit for purpose? Well, 50 years ago, that was questioned. It was generally argued then that it wasn't fit for purpose, that it's still here, and it's survived 50 years longer, and it's still going. So we have a look at the next slide, please. It's fit for purpose if the comparable sales evidence is subsector specific, because it's only going to work properly if you have CBD office comparable sales for the valuation of a CBD office building. As I mentioned earlier, suburban office sales are really not going to help in valuing CBD offices. And that subsector-specific data is important because it allows the valuer to adjust the idiosyncratic risk whilst holding the systematic and unsystematic risk constant. Now, if you don't have relevant comparable sales, the method really isn't going to work very well because the level of adjustment is potentially going to become too great. If we have the next slide, please. Now, I see somebody in the audience has got a cold just like me. Now, the problems of applying the cap rate also increase if you have an unstable property or an unstable property market, or unstable or limited relevance comparable sales. And it gets even worse if each of the subject property and the comparable sales don't have a relatively simple risk profile. So the capitalization rate is fit for purpose in a fairly small number of situations. And problems often arise when it's used in situations where it really doesn't fit. We have a look at the next slide, please. Now, where things start to fall apart is where the capitalization method is applied to multiple multi-tenanted properties. So for the last, certainly in Australia, 15 to 20 years, discounted cash flows become the preferable method in order to deal with multi-tenanted properties, but it still doesn't get around the risk premium issue because you still need to find the risk premium to use in the discount rate, and it doesn't get over the lack of relevant and complete and reliable data. So you can use another method, but you still need complete, relevant, reliable data. If we have a look at the next slide, please. Now, as I mentioned, if you have incomplete or unreliable data, the capitalization of income method is basically dead in the water, simply not fit for purpose. So what do you do? Well, you could go to a market approach, but that is still going to be reliant on data. You could go to a cost approach. However, you then get the big debate over cost versus value and where one stops and the other starts. Or you seek to fix the data and information problems. The next slide, please. So let's have a brief chat about the capitalization rate conundrum. If we have a look at the next slide. Perhaps we could have the next slide, please. Terrific. So, if the capitalization income method is going to work, you need sufficient data. And the problem or the conundrum is how do you apply the capitalization of income method in markets with incomplete or unreliable data? And the simple answer to that is you can't. It doesn't work properly without complete and reliable data, because by nature you're putting garbage in and you're going to get garbage out. Or if you say that more elegantly, the valuation conclusion may be erroneous. Now, incomplete and unreliable data is a fundamental bedrock of an efficient property market. If we have a look at the next slide, please. Complete and reliable data, as many countries have now found, is an incredibly valuable resource. And the days, certainly in Australia, of individual valuation firms keeping their own databases that they spend an awful lot of time and money keeping up to date and keeping secret just to themselves have now long gone. And we are firmly in the era of centralized data by government or private sector providers. Because without complete and reliable data, a property market doesn't function efficiently. Have a look at the next slide, please. Now, for an efficient property market, information is fully impounded into price. Now, if you have a situation where two parties are transacting on a property and they don't have complete and reliable information, the price is going to reflect the information they have, and that may differ from the reality. Therefore, the price is not necessarily reflecting the price that would have occurred had they had all the information. So generally speaking, certainly in many Commonwealth countries, in the absence of complete and reliable data, generally the regulators and the market participants say we need to do something about this. We need to fix our data problem so that we all know what's going on. We have an efficient property market where data is fully impounded into prices and we can easily see what's happening in the market. We have a look at the next slide, please. Now, given that it's so central to many Commonwealth countries, what we often see is government, a local professional body, and an international professional body coming together to create a framework within which data can be collected, stored, and then made available to market participants. Now, certainly in Australia, when this first started, there was a lot of resistance. Groups didn't want to release their data. They felt there'd be a loss of professional advantage. Over time, the market has adjusted to it. People have got used to it. And now we have, provided that you pay the relevant fees, readily available data on most aspects of the property market. Now, usually, if there's government involvement with professional bodies, what comes out is a cost-effective solution. So it's a way of collecting data and providing data to property market participants at a reasonable cost so that they can continue to run their businesses profitably rather than having to pay huge amounts of money for data. If we have a look at the next slide, please. Now, if Australia had gone through the data collection management process now rather than when it did many years ago, it would probably involve some kind of national or international IT group whose business is data collection. Now, that's certainly happened in the residential market here. We have a couple of groups who collect vast amounts of data on residential transactions, and we see them on the breakfast news almost every day of the week. We see them in the newspapers talking about the state of the market, and valuers use them extensively as a source of information. However, if we were to do that now in the commercial market, it would probably produce an expensive solution. Data, as I just showed on the slide, is the new oil. Whoever controls data potentially controls the way in which a market functions and operates, and certainly to a large degree the cost of functioning and operating within that market. We have a look at the next slide, please. So, one way to get around that is for government, professional bodies, and a major IT group to work together. Now, when this has been attempted across various sectors of the economy, certainly in Australia, it's not always worked well. So bringing the government together with the IT groups can be done, but it can be a challenging process. And the next slide, please. So, how do we deal with these industry problems? We have a look at the next slide. If the industry problem is availability of reliable data, then that needs addressing probably by talking to the people whose business is collecting data. Now, certainly the industry problem of use of the capitalization method of income method when it's not necessarily suitable is one that can be addressed by only using it when it's fit for purpose and looking at the alternatives, the other income valuation methods, or the alternative valuation approaches, market and cost, when data isn't available. And as I just mentioned, the opportunity exists for professional data providers to offer solutions. Next slide, please. Oh, I must be at the end. So that's a shameless plug for my two most recent books and the two that are about to come out later in the year. And that concludes what I had to say on the capitalization rate conundrum. Now, I'll leave it to the conference organizers whether we're doing questions or how they'd like to work that. But thank you all for your time, and thank you again to the university and the organizing committee for giving me the opportunity to speak.
Thank you, Professor.